Hello, good evening.
Good
Good
evening.
evening, sir.
Shekoni.
Good evening, sir.
Good evening. Please confirm you can hear me clearly.
We can hear you clearly, sir.
Good evening, sir.
Tonight, our performance management class shall commence. My name is Ashiwaju Dayobelo. I will be taking you some aspect of performance management together with my colleague Adejuwon Daoud. All right. Now let us understand the rule of engagement. The engagement between equity professionals and the students. The engagement between the students and the lecturer. It is the responsibility of the lecturer to ensure that you have quality service sufficient for you to be able to write your exam and pass. To achieve this, we also expect cooperation from the students, particularly for online class, as much as possible. We must maintain decorum. You should check your speaker to ensure that the speaker is muted. So as to avoid interference with the lecture. Having said this, let us look at the overview of performance management. What is the expectation here? What does ICAN expect you to prepare for? As far as performance management is concerned, if you go back to your syllabus, the syllabus provided a clear guidance. The syllabus specified that for you to be able to write performance management very well, you must understand 3 aspects of management accounting or 3 aspects of accounting. One is you must understand cost accounting analysis. Number 2, you must understand you must understand management accounting. Then thirdly, you must have an understanding of quantitative techniques. In other words, Performance management is seated on three things: cost accounting principles, management accounting concepts, and quantitative techniques. It's about performance management. It's about evaluating the performance of the organization, the extent to which the organizational performance drive achievements of the organization. I will explain this. I'm going to start with our first topic. Just one. Now let's go on with the class. Sorry for the break, please. Sorry. The topic tonight is cost estimation. Cost estimation techniques. The topic tonight is cost estimation. Now the question will be, what is cost estimation? Why is cost estimation very important to accountants? What are the techniques or what are the methods of cost estimation? How can we estimate the cost of a product or service? This knowledge is required by accountants because one of the responsibilities of accountants is to supply information that helps management decision making. All right. What is cost estimation? We can define cost estimation as the measurement of historical cost. We can define cost estimation as the measurement of historical cost with a view to helping in the prediction of likely future costs. I'll take that again. Cost estimation. This can be described as the measurement of historical cost with a view to helping in the prediction of likely future costs for management planning, controlling, and decision making. Let us try to drive that with explanation. Cost estimation involves measuring your historical cost value your historical cost. Then using the historical cost as a basis for predicting or estimating likely future costs. Why do we need to estimate costs? Why do management or why do companies need to estimate costs? One, for planning purposes. We are estimating costs for planning purposes. For example, if you are to prepare budgets, currently we are in January, and you are required to prepare budget for June, 6 months' time. You are going to require estimation of likely costs that will happen in 6 months' time. You want to estimate cost of raw material that we are going to incur in 6 months' time. You want to estimate labor costs that the company is likely to incur in 6 months' time. For you to estimate this, you now go back to your historical cost incurred in the past. You now try to measure the cost incurred in the past. You now use the cost in the past to predict the likely cost to be incurred at future period. You can ask yourself, what was raw material cost last year when we produce certain amount of units? What was labor cost last financial year? What was the overhead cost incurred in last financial year? You are now measuring historical cost so as to assist you to plan against future costs you are likely to incur. That is cost estimation. And the purpose of estimating cost is to assist management in planning, is to assist management in decision making, as well as cost control. All right? We have defined cost estimation. What do we require to estimate cost? In addition to your historical cost, you require the knowledge of cost behavior. The knowledge of cost behavior is a prerequisite for cost estimation. I will take that again, because this topic, we have impact on almost all the topic in performance management. We said for you to be able to estimate future costs, you require the knowledge of cost behavior. What is cost behavior? You can define cost behavior as the manner in which costs respond to change in the volume of production. You can define cost behavior as the manner or the way in which costs respond in relation to the volume of production. We have variable cost behavior. What are variable costs? Variable costs are those costs that vary in direct proportion to the volume of production. Please, you are going to listen attentively here. As much as possible, you are going to listen attentively to this discussion. Let me take that again. Variable costs. These are costs that vary in direct proportion to changes in the volume of production. The more we produce, the more the total variable cost incurred. The more you are producing, the more the total variable cost incurred by the business. For example, material cost. The more we produce, the more raw material we are going to consume. Hence, the more raw material cost we are going to incur. But please note, variable cost per unit is constant. Variable cost per unit is constant. Please, you must try to understand the difference between cost per unit and total variable cost. Cost per one will be constant. For example, a bottle of Coke is 100 naira. For example, assuming a bottle of Coke is 100 naira, that means if I buy 2 bottles of Coke, that becomes 200 naira. If I buy 3 bottles of Coke, that becomes 300 naira. The more bottle of Coke we are buying, the higher the total cost, total variable cost. But variable cost per 1 bottle will be the same, constant. That is variable cost. Number 2, we have fixed cost. Number 2, we have fixed cost. Fixed cost. These are costs that remain fixed in total, regardless of the volume of production. Fixed costs. These are costs that remain fixed fixed in total, regardless of the volume of production. For example, rents, the business rents. Whether you produce 1 bottle or you produce 2 bottles or you produce 10,000 bottles, your business rent is fixed. And please note, when we say fixed cost, this does not mean the cost cannot change. The cost can change, but the change will not be as a result of volume of production. When you say fixed cost, we are not saying fixed cost cannot change. For example, the landlord can decide to increase the business rents, but the increase in rents is not as a result of the volume of production. Then number 3, we have mixed cost. Mixed cost. These are costs. These are costs that are partly fixed and partly variable. Fixed cost. These are costs that are partly fixed and partly variable. They contain elements of variable cost and fixed cost. They contain elements of variable cost and fixed cost. Leave just 1 minute. And let's go on. So you must be able to identify variable cost. You must be able to identify fixed cost. And you must be able to identify mixed cost. For you to be able to estimate likely future costs. All right. We have defined cost estimation. We have explained cost behavior, variable cost behavior, fixed cost behavior, and mixed cost behavior. Our next discussion is cost estimation techniques. What are the methods of estimating costs? Now, please, if you have question or clarification, you can indicate with your hands up, or you can send in your question via chat on the Zoom chat room. Okay? cost estimation techniques. We have 5. We have 5 methods of estimating costs. Please, just 1 minute. Let's continue with that. Method of cost estimation. 1. The engineering method. We call it engineering analysis method. The engineering method is also known as work measurement method. The engineering method is otherwise known as work measurement method. This method estimates cost. This method estimates cost function by analyzing the relationship between inputs and outputs in physical terms. For you to use engineering method, you are going to analyze the relationship between the inputs and outputs in physical terms. In this case, engineers who are familiar with technical requirements of the product, engineers who are familiar with the technical requirement of the product, estimate the quantities of raw material needed, as well as the labor and machine hour required for the various operations. Thereafter, prices and rates are applied to the physical measures. You are going to determine, the engineer will determine the quantity of raw materials required to achieve a particular production. The engineer will determine the labor hour required to achieve the particular product. The engineer will determine the machine hours required to achieve the particular product. Thereafter, prices and rates will be applied to these physical measures so as to obtain the cost estimates. This method is useful for estimating cost of repetitive processes. This method is useful for estimating cost of repetitive processes where inputs, outputs relationships are clearly defined. You can use this method. It's mostly used in technological products product where engineer can determine the raw material needed. If you look at construction company now, construction company, they can adopt engineering method. Assuming you approach an engineer that, look, I want to build a duplex. Give them your specification. The engineers will now tell you that, okay, to complete this duplex, this is the number of blocks needed. This is the number of iron needed. This is the cement requirements. This is the sand requirements. The engineers that understand technical requirement now. That is how engineer will tell you that, okay, this duplex should cost you 100 million. This should cost you 50 million. They will use their knowledge to estimate the raw material needed, the labor hour needed, the machine hour needed, and they are going to give you an estimate of the cost of building a duplex. That is method one. Method number two. Method of estimating cost. You can use account analysis method, and you are the accountants. You are going to work closely with the engineers. Over time, you are going to understand what they do. You are going to work closely with a quantity surveyor. A quantity surveyor is the cost accountant when it comes to engineering work, construction work. Obviously, a construction firm also requires an accountant. All right. Excuse me, please. Number two method, account analysis method. This method uses the information contained in the ledger accounts. The account analysis method uses information contained in the ledger accounts. This information is analyzed and categorized. The cost information in the ledger accounts will be evaluated and categorized into variable costs or fixed costs or mixed costs based on the personal judgments or initiative of the accountant. That is account analysis method. As an accountant, You can use your judgment, look at the company's cost information. You can review the company cost information in the ledger account. You can use your personal judgment to classify costs as variable or fixed or mixed cost. But this method is subjective. Third method, scatter diagram. The third method, scatter diagrams. This method is also subjective. It involves plotting on a graph. It involves plotting on a graph the total cost for each activity level. The total cost is represented on the vertical axis, the y-axis. The activity levels. Please, what is activity levels? Activity levels could be production level or sales level. The activity, it could be production or sales. The activity levels are recorded on the horizontal axis, the y-axis. So you are plotting total cost for each activity level on a graph. That will now give you what we call scattered points. Then a straight line a straight line is fitted on the scatter of plotted points by visual approximation. Remember I said for this performance management, you must have a knowledge of quantitative techniques. We call it visual approximation. By guessing, you are drawing a straight line across the plotted points through your own estimation, approximation. The method is highly subjective. All right. Sincerely, the first three we have explained. Examiner will hardly ask you to define this. And the first three, there is hardly calculation. But the last two we are about to discuss, these last two will involve calculation. The last two we are about to discuss will involve computation. What am I trying to stress? You must try to understand clearly the last two to be explained. All right? The high and low method. high and low method of cost estimation. This method uses the two extreme data points to estimate value of fixed cost portion and the variable rates. This method uses the two extreme data points to estimate or to determine the value of fixed cost portion and the variable rates. In the cost equation, y is equal to a plus bs. I'm sure we should have come across this, not some of us. The cost equation or the cost function is represented by y is equal to a plus bx, where your letter y represents the total cost. Your small letter a represents the fixed cost. The small letter b represents variable cost per unit. And the letter x represents volume of production. Please don't forget, total cost is total cost is the summation of total fixed cost plus total variable cost. Please don't forget, total cost is the summation of total fixed cost and total variable cost. If you look at this, our total cost is a mixed cost. Our total cost contains elements of fixed cost and variable cost. All right. Conditions for high and low method. Under what conditions excuse me, under what conditions can we use high and low method to estimate cost? We have three conditions. One, there must be activities at the highest level and the lowest level. Condition number one, you must have activity at the highest level, and there must be activity at the lowest level. Look at it, two extreme data points, extreme end, the highest level and the lowest level. Number two condition, the variable cost per unit must be constant at all levels. Your variable cost per unit must be constant at all levels. Please, again, let me repeat it. Note the difference between variable cost per unit and total variable cost. Some students, they struggle with this. When we say variable cost that vary with volumes, but variable cost per unit will be the same. Condition number 3, the total fixed cost must be the same at all levels. Whether you produce 10,000 or you produce 100,000, the total fixed cost must be the same. These are the conditions for high and low method. These are the conditions for high and low method. Steps involved or steps to be followed when using high and low method. You have like 5 steps. Step number 1. Select the highest output level. That is the activity level. Select the highest output level and the corresponding cost. Note, this may not necessarily be the highest cost. So you are going to select the highest output level and the corresponding cost. Next, select the lowest output level and the corresponding cost. Step 3, calculate the variable rates using the formula below. Variable rate per unit is equal to differences in cost divided by differences in activity level. That is the output level. Your differences in cost divided by differences in your output level. That will give you variable rates per unit. Still step number 3. Use your variable rate per unit to calculate the total variable cost. Use your variable rate per unit to calculate your total variable cost. Lastly, calculate the total fixed cost portion. Our total fixed cost is total cost is equal to total cost minus total variable cost. Note, where inflation makes the cost in each period impossible to be compared, where inflation makes the cost in each period impossible for comparison, cost should be adjusted to the same price level. Your cost should be adjusted to the same price level using price level index. If there's inflation between one period and the other, you might need to adjust the inflation, because inflation can distort cost comparison. All right. Number 5 method, the last method. Regression analysis method. Also known as the least square method. This method uses statistical formula to estimate cost. This method is a statistical method of estimating cost using historical data. It uses statistical method to regress y on x. The method is because all the it takes into consideration all the available, unlike the high and low method, only consider the highest level and the lowest level. But regression analysis method considers all the levels. Regression analysis has two purposes. One, it fits a line to the observed relationship between cost and volume. That is, you can use regression analysis to determine your line of best fit. Secondly, regression analysis can be used to determine the level of confidence that can be placed on the estimated cost. To what extent is this estimated cost reliable or accurate? We call it confidence level. All right, look at the formula here. For this method, you are going to use statistical formula to calculate variable cost, your variable cost per unit. You are going to use statistical formula to calculate the total fixed cost. Your letter A represents the variable rate per unit. And the formula is N summation XY minus summation X multiplied by summation Y divided by N summation X squared minus summation X raised to power 2. Representing the total fixed cost can be calculated or estimated as summation Y divided by N minus B summation X divided by N. Where your N is the number of observations. Your Y is your dependent variable. That is the total cost. Your X is independent variable. That is the volume of production. Your small letter B is your variable rate per unit. Your small letter A is your total fixed cost. So you are going to try, where I want to believe at our previous levels, at one point or the other, we'll have come across this formula. If you are doing projects, regression analysis can be used. All right, let's round up the explanation. We round up with the conditions for regression analysis. So that is conditions. 1, there should be an underlying linear relationship between the two variables. we say linear. One variable must be dependent on the other variable. Number 2, the historical cost data should be adjusted to a common price level index of inflation. Where there's inflation, you are going to adjust the historical costs so as to remove or eliminate the impact of inflation. Number 3, as far as possible, historical cost data should be accurately recorded so that variable costs are properly matched against items produced. Variable cost is related to production, and fixed costs are properly matched against the time period. Please note, this knowledge is needed when you get to your break-even analysis, the cost volume profit analysis. This knowledge is needed when you are doing your budgeting. Okay. Number 4, management should either be confident that conditions which existed in the past will continue to the future, or alternatively, amend the estimates of cost produced if conditions are expected to change. For me to use historical cost to predict future, the assumption is that the conditions that existed in the past will continue to the future. Where conditions are likely to change, then you need to adjust your estimate to reflect expected changes in condition. Lastly, as with any forecasting process, the amount of data is very important. What we are trying to say is, if you are trying to reduce error in your forecasting, in your estimates, it is better to use large amount of data. right. We have come to the end of the explanation. Any question? Clarifications? Okay, while we are awaiting question, let us look at our study pack. Cost behavior and estimation, page 75. Precisely page 77. Question number 2. Page 77, 78. Question number 2. Page 77/78. Question 2. Please check your study pack. Let us review this question together. We have 1 hour 15 minutes. Can somebody confirm the page or reconfirm the page? We need to start the class. We need to start the question, sorry.
We are there, sir.
Chiamaka, are you confirming?
Yes, sir.
All right. Please, as much as possible, I always advise students, this online class, you can maximize it and pass your ICAN. We have done it before, not once, not twice. Students that sat for 5 papers, pass the whole 5 papers. But you must play your parts. What we expect you is that also open the question on your laptop to be very factual. You shouldn't be using your phone, except your phone maybe is big enough. Also, as we read question, you also follow. And there's nothing wrong if you also jot down. Yes, the video will be shared with students. But writing in class also help you. So please, to be very factual with us, with me, in passing the exam. Right. Meeting. Operate 2 factories, one in Apapa, the other in Ikeja. The factory at Apapa is producing output in excess of sales demand, and it will be necessary to reduce outputs in the next period from the current 90% level of activity, in brackets, 11,700 units, to 75%. So we need to reduce production from 90% level to 75% level. At Apapa factory. The Ikeja factory at 90% level of activity, in brackets, in brackets, 8,100 units of a different product. But due to heavy sales demand, it is intended to increase outputs to 115% at Ikeja. Okay. You are giving the following information about cost. Apapa factory, level of activity, 80%, 90%, 100%. We have the, let me take this off small. We have direct material cost, direct labor cost, and we have production overhead cost at 80% level, 90% level, and 100% level. Ikeja factory, 80 to 110. Is given to us. We have the direct material cost, direct labor cost, production overhead cost, and the sales value, all in Naira. Requirements. Requirements A. A statement, you are required to produce a statement to show the expected marginal cost, contribution, and profits for each factory at the proposed level of activity. Okay, let us look at this. Let us look at A first. If you look at the question, there is nowhere examiners say estimate cost. Whether high and low method, but the examiner says estimated marginal cost. expected marginal cost, expected contribution, expected profit. At the proposed level of activity. Now, the question is, we need to explain some of these all the terms. What is marginal cost? I need to know the meaning of marginal cost before I can estimate expected marginal cost. I need to know the meaning of contribution and profit. So, what is marginal cost? Class is silent. There was a temporary network glitch, but we are back. So if I'm to define marginal cost, I can define from marginal cost can be defined from two perspectives. From the perspective of economists, from economics perspective, marginal cost is the additional cost incurred as a result of producing extra units of the products. Additional cost incurred as a result of producing extra units of the company's products. That is economics viewpoints. From the accountant's viewpoints, marginal cost is the summation of all variable costs. Your marginal cost is the addition of all variable costs. Okay? We have defined marginal cost. What is contribution? Your contribution is your sales value less marginal cost. Then what is your profit? You may write down your contribution is your sales value minus your marginal cost. Lastly, your profit. Profit is contribution minus total fixed cost. Having defined this, we can now proceed to the solution. First, let's go to the workings. We are dealing with Apapa factory first. We are starting with Apapa factory. So please look at it, look at the information here. Apapa factory. Levels of activity, 80%, 90%, 100%. Examiners say at Apapa factory, the current level is 90%. At this level, output is 11,700 units. Now you're working one. You are giving output at 90% level. We need to determine what is the output level at 80% and 100%. Then the proposed new level at Apapa factory, 75% level. So you're working number one. And please, to some students, the challenge is, how do I start? You want to determine marginal costs at 75% level of activity. That means how many units will the company produce and sold? I need to know, because the number of units will help me to determine the marginal cost. Variable cost, don't forget, these are costs that vary with the volume. So I need to know the units produced or to be produced. So your working number one is to convert percentage level to output in units. Your working one is to try to convert the percentage level to output in units. How do we do this? All right, please, you can take your pen if you want to be part of the workings. Although at the end of the class, we are going to share this. We are going to share the solution. I'll pick my pen. Oh, why would I go there now? Please, let's continue with the class. Please confirm you can see my screen.
Yes, we can see.
Yes, sir, I can see it.
Yes. What's the meaning of this? I will share. Let me share and continue. All right. I'm trying to pick my pen. Okay. Examiner says at the current level of 90%, outputs here is 11,700 units. If you want to get for 80% level, this becomes 80 divided by 90 multiplied by 11,700. Please work this out. Please get your calculator. If you want to get for 100% level, it becomes 100 over 90 multiplied by 11,700. What do you have here? Oh yeah. 7% level. It
13,000.
becomes 75 over 90. Let's go on with the class. Eighty over 90 multiplied by 11,700. This will give us
10,400. 10,400.
Florence. 10,400. This give me 13,000. 9,750 units, units, units. You have gotten the output in units. Your working number 2. Your working 2. Okay, Mary. I'll try, but it is the network. It is the network that fluctuates. My speaking is consistent, but where there is network glitch, you are likely to have a break in communication. But can you confirm it's better now? Can somebody confirm you can hear me clearly?
I think it's a little better now, sir.
Yeah, it's
Yes.
better
All
now.
right, thank you, Lekon. Let's go on. Now we have resolved working one. Then your working number two is that, recall, we said to estimate cost. You must be able to determine the variable cost, the fixed cost, and the mixed cost. For me to be able to estimate expected marginal cost, I will now ask myself, this material cost, we are still under Papa. This material cost, is it a variable cost or a fixed cost or a mixed cost? I need to know the type of cost behavior. To do this, please, you cannot just assume that material cost is a variable cost. You cannot assume. You are going to carry a test for cost behavior. Look at it quickly. Working number two, text for cost behavior. I want to test direct material cost. Is it a variable cost or fixed cost? To do this test, get your activity levels in percentage. Get the outputs. Outputs here, 10,400. Here, 11,700. Here, 13,000. Next, go and pick your direct material cost that you are giving. Look at it here. We are dealing with a Papa first. 72,800, 81,900, 91,000. Pick this cost. 72,800, 81,900, 91,000. Now, calculate material cost per unit. Look at activity level 80%. The company produced 10,400. Total material cost 72,800. Please compute material cost per unit. Total material cost 72,800 divided by 10. Material cost per unit here. Material cost per unit here. 7 naira. Check the second one. 81,900 divided by 11,700. That will also give you 7 naira. Check the last one. Material cost here per unit, 7 naira. What can you see? The material cost per unit is constant. Recall, we said variable cost per unit must be constant at all levels. For a cost to be regarded as variable cost, that cost per unit must be the same at all levels of production. Whether you produce 80% or you produce 90% or you produce 100%, direct material cost per unit is 7 naira per unit. Therefore, material cost is a variable cost. Can come here. With this, now you can say direct material cost is a variable cost. Please, I didn't understand the 7 naira. Please, can you pick your calculator? Divide total direct material cost. You produce 10,400 units. Total material cost is 72,800. Please compute material cost per unit. Olalekan, please, we are waiting. Please, can you compute and share with us? All right, thank you. So if you compute, and the material cost per unit is the same, whether you produce at 80% level or you produce at 90% level or you produce at 100% level, our direct material cost per unit is 7 naira. In that case, direct material cost is a variable cost. That means I can predict the cost. If we produce at 75% level, we are going to produce 9,700 units. And direct material cost per unit is 7 naira. You can return here. We are going to produce 9,750 multiplied by direct material cost per unit. Please multiply. Your direct material cost is a variable cost. Please multiply.
68,250.
9,750 units. Sorry, I didn't get that. I think the
68,250.
9,750 multiplied by 68,250.
250.
Yeah. 68,250. That means at next financial year, if we produce 9,750 units, the expected direct material cost to be incurred, or the estimated direct material cost to be incurred, is 68,250. You move to labor cost. See under Apapa factory. At 80%, 62,400, 72 and 78. Working number 3. Direct labor. Output here 10,400 units, 13,000 units. Cost here in Naira 62,400, 70,200 in Naira, 8,000 as given in the question. Now, please calculate labor cost per unit. Under 80% level, we produce 10,400 units. Total labor cost was 62,400. Please divide 62,400 divided by 10,400. What do you have?
6 naira.
6 naira. 70,200 divided by 11,700. What do we have?
6 naira.
6 naira also. Check this also.
6 naira.
What can you say? Labor cost per unit is the same. Labor cost per unit produced is the same. That is an indication that this direct labor cost is a variable cost. Now come here. Put your comments. Comments. Because the labor cost per unit is constant at all levels. Therefore, direct labor cost is a variable cost. Is a variable cost. You can now return to your statement. Direct labor cost, a variable cost. We are going to produce 9,750. Labor cost per unit, 6 naira. Please multiply. What is the expected labor cost if you produce at activity level 75%?
9,750.
I have 58,500.
58,500, sorry.
You can see now, our knowledge of variable cost is helping us. Our knowledge of cost behavior is being used to estimate future costs. Next, we go to production overhead cost. Look at this. Test for cost behavior. Production overhead cost. Here we are going to, we produce 10,400 units, 11,700, 13,000 units. Now go and check for Apapa factory. Total overhead here, 59,200, 63,100, and 67,000. Here, 59,200, 63, I'm trying to take the razor now. $63,100, 67,000 naira. Now, calculate overhead cost per unit. Here, if there is fraction, you are going to do 2 decimal places. 59,200 divided by 10,400. Here you have 5.69. Next, 63,100 divided by 11,700. Here you have 5.39. 67,000 divided by 13,000. Here you have 5. What can we see here? You observe that as production volume increases, overhead cost per unit falls. Look at the board. As the volume of production increases, overhead cost per unit falls. This is an indication that this overhead cost is a mixed cost. Where volume of production increases, but the cost per unit falls, this is an indication that that cost is a mixed cost. It contains elements of variable and fixed cost. You can put your comments. Overhead cost per unit falls as production volume increases. This is an indication that production overhead cost is or no space. But we got to create. We need to create this. Let's try to create more space here. It's very necessary. We are going to require that space. We need more space. This space cannot be enough. Let me just take it down. The overhead cost is a miss cost, i.e., containing elements of variable and fees cost. In this case, we need to separate the cost. We need to separate production overhead cost into variable overhead cost and fees overhead cost. In this case, we need to separate the production overhead cost into variable and fixed. In this case, we need to separate production overhead cost into variable and fixed elements. So the question now is, how do we separate it? What method can we use to separate the production overhead cost into variable and fixed? If you look at the question, we have activity at the highest level, and we have activity at the lowest level. You are going to have a new method. Using high and low method. Remember the cost we are trying to separate. Production overhead cost. You come here, You have high and low. You have the output. You have the production overhead cost. At the highest level, what is the highest level? Look at it. 100%, 13,000 units. Overhead cost was 67,000. Pick this. Remember the step for high and low method. Identify the highest activity level. In this case, 13,000 units with the corresponding cost. The corresponding cost is 67,000. Then the lowest activity level, 10,400. The corresponding cost is 59,200. Overhead cost. I'll try to expand this. All right. Then look at the steps. Select the highest activity output level and the corresponding cost. We have done that. Select the lowest output level and the corresponding cost. In this case, the corresponding cost. The cost we are dealing with is production overhead cost. That is where we have the mixed cost. The differences. Differences here, 2,600 units. Differences here.
$7,800.
I can hardly hear you. That's why I'm doing it myself.
So the difference is 7,800.
This is 7,800. Step 3, calculate the variable rate per unit. Thank you, Tosi. Over per unit is equal to differences in cost divided by differences in activity level. That is the output level. Differences in cost, 7,800. 600 units. What do we have?
3 units.
Three units, sir.
3 naira.
It's not 3 units to 3 naira per unit. You have gotten the variable overhead rate per unit. Now, calculate your total variable overhead. You can either calculate at the highest level or the lowest level. Calculate your total variable overhead. You can either calculate this either at the highest level total variable overhead is at the highest level, at the high level. The company produced 13,000 units. Variable overhead rate per unit, 3,000. Total, 39,000. That means out of this total overhead cost, look at it at the highest level. The production overhead cost total is 67,000. Out of this 67,000, total variable overhead is 39,000. What is total overhead is equal to total is equal to your total production overhead cost that is 67,000 minus 39,000. The answer should give us 28,000.
28,000, sir.
Our answer is you have been able to the production overhead into variable elements and fixed elements each. Variable production overhead. We are going to produce at the proposed new level of 75%. At the proposed new level of 75%, we are going to produce 9,750. Variable overhead rate per unit is 3 naira. Please work this out.
29,250.
Thank you. 29,250. 29,250. You have been able to determine the cost behavior for each of the cost elements: direct material, direct labor, and production overhead. You can now sum up. Remember marginal cost, the summation of all the variable costs. Please sum up.
₦156,000.
I don't know what is happening now.
156,000.
Here, student question.
So the answer is 156,000.
156,000. We have estimated the expected marginal cost. If production level is reduced to 75% level, the sales value we are going to sell 9,750. What is selling price per unit? You are giving the sales value at each of the activity level. What is the selling price per unit? I can return here. Working 5. Look at working 5. The unit here 10,400, 11,700, 13,700. No, 13,000 rand. The sales value for our papa has given. Let's check it. Please hold. I'm trying to move this thing up now. Look at the sales figure. For 80%, 28,000, 324 and 260. Ooh, for have mercy. Yeah, sales value here 208. Yeah, 234. Yeah, 260. Please calculate selling price per unit. Volume produced and sold. Total sales revenue. What is selling price per unit?
20 naira per unit.
Yeah, thank you. 20 naira. I can hear that voice now. That means the person she tried to speak a bit louder. 20 naira. You observe that the selling price is the same. Whether we produce at 80% or we produce at 90% or we produce at 100%. That means the selling price for the Apapa product is 20 naira per unit. You can now return. You can come here, sales value. We are going to sell now 1,750. Selling price per one, 20 naira. Please multiply. What is the sales revenue?
195,000.
Yeah,
195,000.
195. Your sales value minus your total marginal cost will give you contribution. Minus, I want to put this in bracket. The marginal cost is 39. Once you get your contributions, sorry, your contribution is 39,000. Once you get your contribution, then deduct your fees overhead costs. The fees overhead cost is 28,000. We calculated this here. The fees overhead. Look at it here. Whether at low level or at highest level, the fees overhead cost is the same. Our final answer. The answer here is 11,000. You are done with the statements. We have been able to produce a statement showing the expected marginal cost, contribution, and revenue at the proposed level of 75%. Any question, please? You can attempt Ikeja factory. Determine the marginal cost, the contribution, any question, clarification? Please, you are going to attempt Ikeja factory. Yes, let's see. No question for now. All right. It's been a wonderful class. The network is not that bad in terms of frequency of network breakdown. We shall be checking out of the classroom. May God give us a better understanding. All right. Good night.
Good night, sir.
Good night, sir. Thank you, sir.
Good night, sir. Thank you, sir.